Welcome back to The Explainer. So, have you noticed how the headlines keep telling us the economy is absolutely roaring, but, well, the view from the ground feels kind of fragile? Today, we're unpacking what analysts are calling the Great Divergence of May 2026. We're going to see exactly how this hyper-concentrated tech boom is essentially acting as a massive smokescreen, literally masking deep, systemic fractures in our physical economy. It's a wildly fascinating structural disconnect, and to really grasp it, we got to look at the numbers.
Here is our roadmap for today's explainer. 1. The market's grand illusion. 2. The silicon supremacy. 3. Reality bites, covering physical friction. 4. Geopolitics and global choke points. 5. Impending catalysts. And 6. Managing the divergence. Let's just jump right in.
Kicking things off with Section 1, the market's grand illusion.
Okay, check this out. A massive 32.8% jump for Dell Technologies. Now, this wasn't just some gradual climb, right? This was a Q1 earnings blowout, driven 100% by an insatiable demand for AI servers. And this single hyper-concentrated surge actually helped push the broader NASDAQ up 8.4%. That makes it the best two-month stretch we've seen since way back in late 2002. If you're just glancing at this top-line number, you'd probably think, wow, we are in a golden era of broad economic expansion.
But that booming illusion kind of shatters when we bring in this stark reality check from David Rosenberg. He points out that if you actually look underneath the surface, it's an incredibly lopsided environment. He calls it a bad breath market, which basically means the gains are restricted to just a tiny handful of companies. Think about it. It's highly unusual to be popping champagne over record stock market highs when massive foundational sectors, like financials, are sitting dangerously close to correction territory.
You can clearly see this stark contrast here. The market's record highs were somehow achieved even though the vast majority of S&P 500 stocks actually fell by the end of the month. You've got mega-cap tech acting as this massive anchor on one side of the scale, heavily outweighing broad losses in things like consumer staples, communication services, and discretionary spending. Basically, the very top is just completely pulling away from the base.
Which brings us to Section 2, the silicon supremacy.
We are watching a monumental changing of the guard happen right in front of us. For decades, the entire global economy was anchored by the fossil base, oil. But today, we have to contrast that directly against the rapidly rising silicon base. The literal foundation of global value is shifting from extracting energy out of the ground to processing data through microchips. It is a massive pivot.
And to put that into perspective, the top three memory chip makers, we're talking Samsung, SK Hynix, and Micron, are now valued at over $1 trillion each. That's a combined market cap well over $3 trillion. Now compare that to the absolute titan of the fossil base, Saudi Aramco, which is sitting at roughly $1.8 trillion. The math on that? The silicon giants are now valued 22% higher than the combined market cap of the top three oil companies. It's a stunning supremacy gap that's completely redefining global power.
This hyper-concentration is so intense it's actually almost absurd. The entire Russell 2000 index, which represents 2,000 small-cap companies, by the way, is fundamentally smaller in total market cap than just Nvidia and Apple combined. Insane, right? Because all the safe money is locked up in these few mega-cap tech giants, investors who actually want growth are frantically chasing small-cap momentum plays. They're driving these speculative waves into high-risk frontiers, stuff like quantum computing and space exploration, even with rising rate expectations looming over the market.
Moving on to Section 3, reality bites. We need to talk about physical friction and systemic vulnerabilities.
So, to truly understand this divergence, we can't just stare at stock tickers all day. We really need to check the ground floor, specifically everyday labor compensation.
Take a look at how the economic pie is splitting, because it is dramatic. Corporate profit share has surged to 12.1%, which is the highest it's been since 1950. But look at the flip side. Labor's slice of that exact same economic pie has plummeted to 51%. That is its absolute lowest point since they started keeping records in 1947. Worker compensation barely even registered a pulse. This really isolates the fundamental disconnect perfectly. We've got this wildly ebullient, record-breaking stock market superimposed directly over a deeply anxious, financially stretched consumer public.
And you know what's fascinating? We see this exact same tension mirrored in technology itself. Over in the digital realm, OpenAI recently cracked the Erdos problem, which is this incredibly complex 80-year-old math puzzle.
It's a frictionless, absolutely profound cognitive leap. But try taking that AI and forcing it into the physical world. Physical AI, like the robotaxis from Waymo or Tesla, face immense real-world friction. Attempting to actually scale these across the US has resulted in literal, real-world collisions and mounting physical resistance from local governments, so the digital flies while the physical crashes.
All right, Section 4, Geopolitics and Global Choke Points. Time to look at institutional gridlock.
This gridlock extends right into the heart of international diplomacy. The United Nations is actually facing a critical cash depletion deadline by mid-August, and this is being driven by massive structural deficits. The U.S. is currently withholding over $4 billion in arrears, pulling out of programs to combat what it views as wasteful spending. At the exact same time, China is strategically slow-walking its mandatory payments while simultaneously injecting $850 million to position itself as the de facto primary contributor. Regardless of your politics, the physical reality here is total institutional gridlock right at a moment of extreme global transition.
Now add to this institutional gridlock the very real, very physical logistical choke points of our time. Out on the seas, we've got maritime shadows. Commercial ships are actively sailing dark, meaning they're turning off their transponders just to sneak through the Strait of Hormuz safely. It's an incredibly precarious relief valve for the global economy. And if we look up to aerospace, we're seeing dramatic physical stumbles. Take Blue Origin's rocket violently exploding on its launch pad during testing recently, which only widens the orbital capability gap. It seems like every time we try to move physical goods or physical mass, we hit immense friction.
Let's turn to Section 5, Impending Catalysts. Let's see what might bridge this divide.
This particular week acts as the ultimate test of this entire macro divergence. Monday, we get a solid read on the physical economy with the ISM manufacturing PMI. Then on Wednesday, the digital engine gets tested with Broadcom's earnings, which is a massive indicator for AI hardware demand. But it all culminates on Friday with the monthly jobs report. This is it, the ultimate showdown, a blistering stock market pitted directly against the gritty reality of consumer paychecks.
What's truly wild is watching where capital actually flows when it's caught between these two extremes. Surprisingly, we're seeing money pour vigorously into unique cultural escapes. For example, people are paying a highly lucrative $350 a day just to go look at the Iberian lynx in Spain and Portugal. Meanwhile, FIFA is targeting a massive $11 billion in revenue for the upcoming World Cup. Capital is happily hunting for expensive weekend escapes, even as everyday physical manufacturing is struggling just to keep the lights on.
And finally, Section 6, Managing the Divergence. How do we actually navigate this chasm?
Bringing everything together from our explainer today. On one side, you've got this massive, hyper-concentrated momentum in digital acceleration. Your AI servers and multi-trillion-dollar memory chips growing completely without friction. But this is directly offset by severe systemic vulnerabilities in the physical world. We've got a hollowing labor share hitting lows we haven't seen since 1947, plus global financial and geopolitical strangulation. The digital economy hits the gas, while the physical economy aggressively slams on the brakes. And capital? It's being forced to flow precisely through the narrow gaps between them.
I want to leave you with this final, vital question. As capital is squeezed through this great divergence, you really have to make a choice. Are you going to position yourself with a digital engine, soaring on silicon and code, but perhaps completely detached from everyday reality? Or are you investing in the friction, the physical world, where the real-world problems and maybe the massive real-world turnarounds are waiting to be solved? Think about where your time, energy, and resources are going. Catch you next time.